Welcome to the video, everyone. I had some people reach out to me about why they would actually own life insurance on their business. A good friend of mine said, hey, my business partner is telling me to get some life insurance on the corporation. Why would I do that? And what this individual was talking about was something called a buy-sell agreement. So I'm going to be talking about the basics of how it works, why it's important, and why you should potentially consider one. So we have a company, and we're going to call this company, let's call it XYZ. There's two shareholders, and they both own 50% of the shares. Okay? One business owner is called Bonnie, and the other shareholder is called Jack. And Bonnie is married to Clyde, and Jack is married to Joe. Now, these people are young, and let's say that company XYZ is a plumbing company, and they're doing great. They've been working hard for 2 or 3 years. They're finally making money, and husband and wife, they get along with the other shareholders. So they go for dinners together, they go to functions, they go to the park, they play patty cake, all that good stuff. But here's the thing is, Clyde brings up a very good point. He says, well, if my wife were to pass away, what happens to her shares? And Jack says, well, they get passed down to me. And that's what I hear a lot. People think that the shares just go down to the other shareholder. That's incorrect. By law, the shares of the company will go to the common law, the spouse, or the estate. So now there's a bit of a problem here. Because now Jack has to pay Clyde. Meanwhile, Clyde doesn't even know what a faucet is, right? So do you think Clyde is going to want to run a plumbing business when, let's say, he's an accountant? And same with the other way around. Clyde obviously is going to want a paycheck coming in because they have a family, they have kids, they have expenses. But do you think Jack is going to want to continuously to give money to the other shareholders? So we have a bit of a problem here. Now, they've all come to the understanding that our spouses are great, but they are outside of the business. Let's keep it that way. Okay. Now, this is why it's important to establish a buy-sell arrangement. Okay. Now, there's multiple triggering factors that can be in a buy-sell. One of them is death. So, for example, let's say Bonnie kicks the bucket. Right? Then the shares would automatically go to Clyde, and then Jack, and they have a buy-sell, so Jack would pay a lump sum to Clyde. Clyde's happy, out of the business, and now Jack owns 100% of the business. Clyde can be on his merry way, and Jack can have complete operations of the plumbing business. Since this is a new company, there might not be a lot of cash available in the company. So now there might not be money laying around to buy out the shares. And keep in mind, now the other shareholder has to hire more people, train them, etc., and cut a bi-weekly check or a monthly check to the shareholder. There might not be enough cash sitting around for that. So what the business owners can do instead is they can just insure themselves with a life insurance policy, which is paid with corporate tax dollars, which is attractive to a business owner. The life insurance policy versus death would go to the business, would then go to something called a capital dividend account, which is a notional account that your accountant would open up. And then since there was a USA put in place, which stands for Universal Shareholders Agreement, I'll explain that in another video. Since there was a shareholders agreement in place, the life insurance policy is used to buy out the other shareholder. Now, another triggering clause can be disability, and the same rules apply. What happens if Bonnie gets into a car accident and can't perform the regular duties of her occupation? Do you think Jack is going to want to continuously cut a check for Bonnie while she's at home recovering, right? And keep in mind, Jack has to still hire someone new, train them. That's going to cost money. And do you think it's fair to both parties that, that she gets to recover at home, get a paycheck while Jack has to spend more money out of the corporation to hire someone. Now, I have come across buy-sell arrangements where there actually has been no funding put in place. And what I hear is, oh, well, I'll just put $50 a month away and, if something happens, I can pay for it. Okay, well, what happens if your business partner dies tomorrow, right? And why worry about it? Why stress yourself out when you can just insure yourself? And then if something ever happens, let's say you're putting $50 a month towards a policy that is corporately owned with corporate tax dollars. And if something were to happen, $1 million check can get passed down tax-free. Okay? Why worry about that? And I know business owners love their write-offs. Please do not write off your life insurance. However, there is disability protection that you can put in place that the corporation can own. The corporation can pay for it, and you can write it off at the end of the year. But that's a certain type of disability coverage. And that is pretty much it. So if you have any questions, like, comment, subscribe below, give me a shout. Yeah, how do you guys like that? How'd you guys like that? I've been better at this, right?